It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
Hey, welcome back to the Real Estate Breakfast as we stream right across Australia with the latest conversations shaping today's property market, from Bendigo to the Gold Coast and all of those regional hotspots in between. Welcome aboard. It is a Thursday morning, June the 18th. If you're blowing out the candles today, you are in pretty good company. And happy birthday for today. Paul McCartney is turning 84. Alison Moyet. Now, if you know Alison, you'll remember that song from the 80s, Invisible, big hit for her. She's turning 65. And if you're a country lover of music, Blake Shelton is turning 50. Now, it was also on this day, back in 2023, the submersible Titan lost contact during a dive to the wreck of the Titanic. Really tragic story here, which is captured brilliantly in a documentary on Netflix. If you haven't seen it, check it out. Basically, the CEO of this company, I think he made this particular submersible from carbon. It just wasn't thick enough, and yeah, that was a big tragedy, including a billionaire with his teenage son. Now, Australia's auction market continues to be a talking point because it's continuing to soften. Clearance rates are well below long-term averages. Are you thinking about putting your property on the market using an auction either in Melbourne or Sydney? If so, how nervous are you regarding these lower clearance rates? And joined at the hip with the auction market is the higher borrowing costs, which are continuing to impact Sydney as well as Melbourne. There is right now a slower buyer activity demand and longer selling times. And the combination of higher interest rates, softer price growth and recent housing tax changes really is continuing to influence investor behaviour. Lending demand also, that has moderated, and many investors are reassessing future purchases as they wait for greater certainty around the economic outlook. Let's go right now to Sydney and catch up with John Lindeman from Property Power Partners. And welcome, John, to the Real Estate Breakfast. First time. I know this has been a long time coming. And I guess I should throw off the first question about the RBA with their decision on Tuesday. What did you make of it?
Yes, good morning, Craig, and hello, everyone. It's great to be part of the program. Well, it was not unexpected. I thought the RBA is going to keep rates on hold because of all the uncertainty that's out there at the moment, with the Middle East crisis and the changes to the housing rules and the budget. So I thought they're going to just wait and see what happens. So not unexpected, and probably, a great relief for a lot of people that 3 rate rises might be the end of it.
Yeah, the thing with the RBA is you can't pick it. There would have been people just on tenterhooks on Tuesday waiting for that announcement, but thankfully there was no raise with the cash rate. Also, there's a lot of concern about, is the market going to crash? I mean, we've heard all of this before, but what are your takeaways for a lot of the commentary talking about 20, some people saying 30% crash, which I think is crazy?
It is. I've studied the property market for a long, long time, and I went right back to 1901 and looked at the performance of the property market right back to Federation. What I saw in looking at all the changes in prices over time is that the worst we've ever done, and that was during the Great Depression, and it took about 3 years for property prices to fall by about 20%. Now, that's the worst that's ever happened, and we're not looking at anything like that right now. The fundamentals of the property market are quite sound. So, I think talk of a crash is absolute nonsense. It may soften a bit. People are uncertain. They're not quite sure what's going to happen. They're holding back, but we've still got a massive shortage of property. So prices will continue to rise over time.
Yeah, and in terms of a crash, you've also got in the mix of this, and I think a lot of it is coming from first home buyers. They're unsure because things have slowed down somewhat, especially in Sydney and Melbourne. But they're asking, is there an upper limit to housing prices? How do you explain that, especially to first home buyers? Because they're looking for some good news, but unfortunately, I don't think it's coming with that particular question.
It's very difficult for first-home buyers to get into the market. The government has made it a lot easier with their 5% deposit guarantee. So that's enabled a lot of first-home buyers to get in with lower deposit, but they've still got to be able to afford the repayments. So when interest rates go up, it makes it harder for them. But when you look at the overall market, first-home buyers are about 10% of the market. People, after about 4 or 5 years, they tend to upgrade. They have less reliance on finance and they've got more equity. When you look at the top end of the market, the well-established suburbs, people own their own homes without any debt whatsoever. About a third of Australian property is owned without any debt. So that means that prices in those areas can keep on going up. So the good news is once you're in there and you're a first-home buyer, you've got your home, it's going to go up in value, you can upgrade over time and that growth will continue. The trick is, of course, is getting into the market in the first place. Hopefully interest rates will start to reduce and make it easier for first-home buyers to actually enter the market.
So the rise in these first-home buyers using the likes of the low deposit government scheme, that appears to be changing the composition of sales across both Sydney and Melbourne, where the median prices have fallen and the immediate assumption is that the market is weakening. If more buyers are purchasing in affordable suburbs, is that creating perhaps a misleading picture of the overall market? And what should investors be watching instead of perhaps those headline median prices at the moment?
It's very true, Craig. What's happening is it's a direct result of the fact that we use the median as the term of measurement in the property market. And the median is simply the middle point of all sales. So if you've got more sales occurring at the low end of the market, it actually drags the median down. Now, in Sydney and Melbourne, that's exactly what's been happening. When we look at the first home buyer markets, say in Melbourne and sort of Melton, Cranbourne, Pakenham, there's been strong price growth in some areas over 15% in the last year. And the same in Sydney. It's the lower priced areas around Campbelltown, Blacktown, Penrith. That's where all the growth has been occurring. But when you look at the median, you say, hang on, prices are falling. They're not falling at all. They're actually just more sales occurring at the lower end of the market.
All right, we are talking to John this morning. When we come back, if you're a first-time home buyer and you're looking at affordability, I'm going to ask John that question. Where should you be buying after this?
Eager to expand your property expertise? Enhance your real estate know-how with us. It's the Real Estate Podcast, talking properties from 6 a.m. every day from every corner of the Australian real estate market.
Let's have a look at Hobart's property market with some median house and unit price. The median house price at the moment, all the eights, 888,000. Annual growth, it is in the negative 9.8%. Median rent is around $660 per week, a rental yield of 3.4%. Median days on market at the moment, 35 days. Units, they are definitely faring a lot better. Unit price median 891,000, annual gross on the plus side 5.8%, median rent $650 per week, the rental yield 4.5%. And the days on the market a lot longer with the units. I'm not sure if that information is right. They're saying 91 days. It is a Real Estate Thursday. John in Sydney is with us. Yeah, John, Hobart's housing market, it has softened over the past year. The unit market does continue to show resilience. Houses are down nearly 10% annually, while units have posted a growth of almost 6%, as I've mentioned. So what do you make of both the Hobart market and Tasmanian real estate market at the moment?
Well, what we're seeing in Tasmania generally has a very, very low population growth rate. A lot of younger people leave for the mainland. They look for better opportunities for entertainment, education, and so on. So there's a lot of young people leaving Tasmania every year. They're replaced by older folk who tend to be, sort of downsizers in retirement. They move to Tasmania because they prefer the milder climate and the gentler lifestyle. So what we see in places like Hobart, that softening in demand because younger people are leaving. Older people aren't moving into places like Hobart. They're moving into the coastal areas where we're seeing a lot of more price growth potential, places like Devonport, Ulverston, those sorts of coastal retiree areas. So they're doing quite well at the moment. And the unit market, that's partly due to the fact that Tasmania has a unique climate, and you find that more people prefer to live in units. And the median price of a two-bedroom unit in Hobart, as you said, it's about $800,000. Compare that to Melbourne, where it's about $600,000. There's a huge difference. More people prefer to live in units in Hobart because of the climate and the fact that the younger people, lower maintenance, easier access, and so on. They prefer that type of accommodation.
Yeah, no, it's a good point that you make, because a lot of people will sort of looked at those numbers and gone, wow, there is such a big difference between Hobart unit prices and Melbourne prices. And a shout out to anybody listening in Launceston. I used to live there many, many, many years ago for about 12 months and was very, very sociable. Now, for somebody sitting on the sidelines, especially first home buyers, trying to buy with affordability in mind, what areas and suburbs do you think they should be looking at around the country at the moment if they're prepared to move?
I think the best areas, and this goes for investors as well, if you look at the inner urban unit markets of Melbourne, places like Brunswick, Footscray and so on, you can buy a unit, two-bedroom unit for around $500,000. The same story goes for the growth corridor areas in Canberra along the light rail route. Again, you can buy a two-bedroom unit in those places like Belconnen for around $500,000. Now, that's extraordinary value because the replacement value of two-bedroom units in those areas is about $200,000 more than that. So it means that they're way below where they should be. If you can get into those markets either as an owner-occupier or an investor, you're going to be doing very, very well over coming years because that's where everybody wants to live and prices will be going up dramatically.
And just before I let you go, John, what is the standout thing that you have noticed the most in this year of 2026? If I was to say, just name one thing that really, above anything else, you've kind of zeroed in at, you've looked at it and said, yeah, that's a real talking piece right there.
I think the main thing is the introduction of that 5% deposit guarantee without any limit on numbers, without any qualification as to income. It's enabled an enormous number of first-home buyers to enter the market. And there is an upper limit to this. If you look in Sydney, the maximum price cap is $1.5 million. In Melbourne, it's $950,000. So you can see that these first-home buyer suburbs could go up to that amount quite quickly as long as interest rates don't rise. So I think that's the one big standout, is the huge number of first-home buyers that have gone into the market with 5% deposit.
Well, there's still plenty of gas in the tank for this year. It just remains to be seen what is likely to happen before we close out 2026. Hey, thanks for coming on to the Real Estate Breakfast. We'll get you back another time and enjoy your Thursday.
Thank you very much, Craig. Good luck, everyone, with your property purchasing.
We help to break down real estate every day to help you better understand the Australian property market.
Yeah, so Dural, it is a premium, highly sought-after area. It is driven by acreage and lifestyle properties. What makes it that way? Because it really has developed, hasn't it, over the last 25 years?
Yeah, that's right. Going back, say, 25 years ago, the ratio of acreage to residential for our office was probably like an 80-20% type split. We now are selling pretty much 50-50 in terms of residential to acreage, and that's just with the urban growth coming closer towards us.
Let's talk about what has been the standout feature then in your area for 2026 so far.
I think the residential market's probably a standout at the moment, just given the volume of buyers still evident in that marketplace. But I think when conditions change, the lifestyle market can move aggressively both ways. So while we're still selling a lot of acreage property, it is taking a little bit longer. I would say at the moment our residential market is still fairly strong.
We connect you to the best real estate information across Australia. The Real Estate Podcast.